I think you can finesse the game a little bit. And some people do this really well. It's not what I did. But if like you got an offer to join Y Combinator tomorrow and you went out and shopped that, I guarantee you could probably get a fund to like throw down a term sheet. More for like, I think angels are some of the most helpful investors to have on your cap table, but a lot of times the best time to go after them is after you've got the momentum and are oversubscribed or whatever. We had like 800 committed on 1.5, and then we were at 1.1 the Tuesday before Thanksgiving, and then Friday we were at we hit like 1.8 or something like that. And then so there's 3 days before Thanksgiving, and then by end of Wednesday we were at 5 on what was supposed to be like 1.5.
Welcome to the Product Market Fit Show, brought to you by Mistral, a seed stage firm based in Canada. I'm Pablo. I'm a founder turned VC. My goal is to help early stage founders like you find product market fit. Well, Andrew, welcome to the show.
Thanks for having me, man.
So listen, man, I mean, we're just jumping right in here. Like I was scrolling LinkedIn as I do as a busy VC, you know, that's half my job. No kidding. But I saw your post on there and it said that to raise a pre-seed, I think it was like you spoke with like over 100, well over 100 investors, 120. And then you said you actually had another 200 names on the list that you hadn't gone through. I must admit, like, especially for those early rounds, those pre-seed rounds, it's not something I see commonly. Like I hear it talked about, hey, you should talk to a lot of people, all this sort of thing. But if I actually am honest with the founders I meet, the founders I speak with, the ones in our portfolio, how many of them go and talk to that quantity of VCs and truly make it a process? Very, very few. And obviously it worked for you. Like you closed that round, and I want to walk through all of that. Like I want to get super tactical today on your thinking about it, the strategy, how you implemented it, how you did it from intros all the way to meetings, to the deck, to the data room, if you built one, whatever. I'll stop there. Maybe just as a first question, how did you think about fundraising? Why did you even approach it this methodically?
Great questions. And I agree with you the way you characterized it. I think it's the reason I wrote this post is I was getting asked about this a lot by like other founders that were about to raise a similar-ish round. And I just think it's something people like. The only people who'd ever really told this to me had been other founders, and it was like not, and it had been one-on-one. It was like not something that you really saw, or even like sometimes no one would tell me, but I would just observe. Like I had a friend that raised around maybe 6 months before us, and I talked to a lot of people to get like about a similar size round done. And so I think it's just one of those things where like people want to act like, oh man, we just like went out there and we're so great and our company's so interesting and we're so compelling as founders that like the third VC I met, they just gave us a term sheet and wired money to our bank accounts. All the more so in like an era where like it does seem like whenever you hear about a fundraise, it seems like there's a ton of momentum and everyone's acting like it just seemed like, well, of course, that was so inevitable. I think people just don't realize like how much volume, even for like a really successful raise, it can take. The way I thought about it was we had hit the point with where our company was at where we knew it was like time to raise money. And I actually don't think like we didn't even take it as a given when we were getting started that we were going to raise venture for this. It just kind of eventually became apparent that we wanted to build the most ambitious company possible. We wanted to capitalize that the right way. And it became very clear, like there was a clear like case to raise venture. And then two, it was like clear that we needed to do it to build the best version of the company we needed to build. And then in terms of like actually getting a round on, I think that I've done a little bit of just like tiny check angel investing. I've worked at other startups and I have a lot of friends that are founders. So I'd seen it from their perspective and I just knew also too, the market sucked, especially end of last year. I think it's a little bit better right now. Like people were, I was just expecting it's going to just take a lot of no's. And also too, at the pre-seed stage, especially, it's like hopes and dreams, right? Like you're talking about a team, it's mostly a team in a market.
Yeah, set some context, like how old was your company and then more or less how much you're raising, like sub 1 million, 1 to 2, 4 to 5, like what were you thinking?
So even this gets into like some nuances here, but so we were raising, the context of the company was like a company I was head of growth at before this was like early stage startup raised from Andreessen. They had a like acqui-hire type exit early last year. I left a little bit right before the acquisition finished. I'd spent a couple months on what eventually became this company. So I'd say I officially started working on what became this company, Taxwire, in April of last year. But I don't even think I really was like, okay, for sure, this is going to become a company until probably the end of May. And so then there was like, so April through August, you can kind of think of as me recruiting co-founders, doing a ton of customer discovery and just really understand like iterating on the product I thought we wanted to build. And then August, my co-founder came in And then we went out and raised, I think we have officially kicked off this pre-seed raise, I guess like a late September, early October. Well, actually, no, we started prepping for it in late September. We didn't really start raising until October, and we went out to raise 1.5, and we ended up raising about a little over 2.7. And so, but like, so even so, on the reason I said like that amount mattered. And when we were there, before I forget, we did a bunch of work to get our materials right. We really understood our customer and our market and stuff like that before we went out and raised. And then we had 2 customers that were like paying us, but I mean, it was like almost pre-product. We had a prototype, but it wasn't like really a full product. And a very clear idea of like what it was we were going to build.
And do you agree? Like, I mean, the way I think about it is like everything we're talking about here is really process and optimization. It's like the 20% of a successful round. The 80% comes before. Like it's the actual team.
Yeah, totally.
The actual
it's like
product, the actual work you've done.
Like you have to be investable. Like if you're investable, you're in a good market, you as a team are investable and you've got like real meat to it, then the rest of it is just like getting your story down and then running a process. And it's a ton of work, but like those things are actually like all of the process stuff works for you if you've done the first piece. If you haven't done the first piece, if you like you or your team or whatever is not very investable, or like you don't like really have an investable business, investable market, it's going to be really hard to fundraise because it's just like all the other stuff only works if like that first piece is done.
And so walk me through like the steps, right? Like you decide, okay, we're gonna fundraise, we're gonna do this. First thing is, do you work on the deck? Do you work on a data room? Do you start talking to people right away? What's the first thing you?
I started working on a memo actually originally, and that's partially how I just think much better. I have to be able to write something out to really be able to articulate it well. So a lot of like how I think through problems is just to like start writing something down. And so we wrote a memo first, and then eventually we kind of built a deck. And then we used the deck primarily in like most of initial meetings, and like memo was more of a diligence thing. But I wrote a memo, eventually built a deck.
And did you find there's actually a question I got not long ago? It was like, hey, what do you think about memos? Like people are telling me that like slide decks aren't that cool anymore. Memos are cool. And I'm like, man, I don't know. Like for me on the receiving end, like send me a deck.
Yeah, I think there's like they serve different purposes. People talk about using one or the other. I think the memo is ideally, I would personally prefer to just use a memo, but the reality is most VCs, no offense, are just going to go like boop 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 boop.
That's the problem. Yeah, that's right. I'm lazy.
And so yeah. It's like I can see the metrics on my docs end. The average investor spends like between 1 and 2 minutes max in my deck, and so you really don't have a ton of time. And so I think the deck is great for like getting the intro and setting the initial context. And the memo is good for once you've like pulled someone's attention and they're actually serious about maybe investing in your business.
That makes total sense. But the way your order was memo first, get the thoughts out, get like the kind of narrative down, and then use that to create a deck.
Yeah. And it's like, it kind of, it just worked out that way. But actually first I was kind of wanting to use the memo, I'll be honest, instead of the deck. I didn't want to do the deck. And then I like got over myself and did the deck before we went out to market. But I'm glad we did the memo because I think I actually felt like I'd wasted my time initially. And then later on, when we got through diligence in a pretty compressed timeline, and like I heard back from all the investors that we went through diligence with, like it was a pretty big piece of them building conviction. So it was useful, but it was just served a different purpose than
I could see that, especially for pre-seed, which like you said, there's not much meat there. Like it's really team market fit. It's the team, it's the market. Like having some written out that walks somebody through how you're thinking about it, I think can help a lot. But yeah, it's way deeper in the funnel. It's like they like the idea, they've met you, they like it, they're trying to build conviction, and also some people forget, like in many cases, people work in a fund, they got other people they need to convince, right? So they can share this with other people. They can use that to like create kind of their own internal pitch. So I could see that serving a great purpose.
It's the internal pitch, and most funds are going to write their own memo. And so it's like you're saving them some work. And I think the big thing is just demonstrating rigor of thought. And I think this is true at seed too, even if you're a little further along, like ultimately still there's a ton of risk at this stage. And so people are underwriting, not that you have all the answers, but that they believe in how you think about the problem and how, and like, do they trust you and do they trust your judgment and how you're going to go build a business? And you're like doing a memo on just the way you answer questions. It's not about like that you have every answer. It's that like, do they trust how you think about it, how you got to the conclusions you got to? And then like engaging with you through that, like, do they just like believe in you? And I think that's like doing things like writing a memo and being able to articulate like why and how you think about something either increases or decreases an investor's conviction.
Walk me through this. Like, how premeditated was the reach out? Like, did you know ahead of time, I'm going to reach out to hundreds of people, or did you have like some conversations or something happened and then you decided, you know what, like we really need to expand this, we need to go wider? Like, how did that play out?
A little bit of both. We had, so I know an above average, maybe for some, like I'm fairly young, but I've got a decent network of investors. And so I was relatively confident that we could get in front of most people. And I knew a lot of angels specifically. So we actually had a bunch of angels committed right up front that were just people we'd like all the founders of companies I've worked at before, invested, previous bosses, a ton of people I just worked with at previous startups before, all invested. And so, but part of getting those folks involved too was as we were talking to them and I was like in the middle of writing this memo, building this deck, we were getting feedback on the pitch. So I actually think and we were like really getting the narrative down and like figuring out what questions were coming up a lot. And then, but also too, as those people were kind of coming together, I was also mapping out who I could get introduced to. And then I also just built like a massive list. So I have an Airtable. I can even like screen share it.
While you're pulling it up, let me ask this. What percent, like when you decided to do this fundraise, what percent of your time was dedicated to this? Like 10%, 50%, 90%? This
is like 80, 90% for me. Yeah, once we were going hard, it was like 90%. And then it was like in the weeks where we were kind of getting prepped, it was probably like 60, 70%. And then it shifted to about 90% until it was over.
Top priority almost.
For me, yeah. My co-founder was probably like 10 to 15% of his priorities. So it was like the two of us. So he was building and I was like out here raising when that happened.
So walk me through each of those steps. Like, first of all, the names. I mean, so there's the people you know, that's the easy part, but the ones that you don't know, where do you get that list? How do you
I literally, there's so many Google Sheets on the internet. I can't even keep track of them, but there's a ton of lists on the internet of just like investors. And so it's not hard to find investor lists to be, in my opinion. Like I found a few from people I trusted and then just like had that list. And then I kind of filtered it for who I thought would invest at pre-seed seed. And then who maybe a little bit of focus on finding people that were specifically investing in our market. And then after that, we literally went to all the people we knew, and then to some extent did it ourselves and just mapped out who could introduce us to who. And
you're just asking, like, you're just sharing this Airtable with people, like,
hey. I'm like texting people like, hey, yeah. Well, I'm texting like, hey, like, how good is your intro to this person? Like, you know them, like, could you intro? And then I would do the other thing and be like, is there someone that we don't have in here that we should have in here? And so we kind of mapped that. And then honestly, as you're raising, you're continually doing this. So every single
time. But how far did you get on this before like pressing go? Like you're doing your meetings with people you already knew, but the new people.
Yeah. No, actually, sometimes I didn't start with people I knew. I kind of waited for, depending on how I knew them, I might have waited if I was like really wanted them to invest. So I have this, you get this big list. You've kind of, at the same time, you're getting your story together and you're getting your materials together. And then there was a point where like we had mapped out this pretty well. Like we had a big list. It's never fully done, but it was like good enough. And then
what was it, like 200? Like 200 names?
It was 100. We had like hundreds in there.
Okay.
And so it was at least like 200-300 names. I mean, there's so many funds doing pre-seed seed. There's a ton of investors out there. So we had the people we cared about, that we knew we cared about, and then just like a bunch of other names that we like, maybe were like just they're an investor at pre-seed seed. And then we started doing, I think like I characterize as the practice round, which is friendlies that you trust to give you good feedback, angels, other founders, whatever. And then honestly talking to investors, like you're not going to be disappointed if they don't invest because for whatever reason, you just like, you don't, it's like you're probably not pitching Sequoia as your like very first.
Now, just question, with those friendlies, did you set it up as like, hey, I'm raising, like, let's have a call? Or did you set it up as like, I'm going to raise, would love some feedback? Like, how did you structure that?
It's very person by person. In like some cases, it's like if someone I know really, really well, it's like I might text them, email them, whatever, and just be like, hey, I'm getting prepped for the raise. Would love to get your thoughts on this. And then in other cases, like they might have already even committed. Whatever you're doing, like I'm just going to invest. And so just like tell me and I'd be like, hey, like you can invest in the RUV link here, but I'd love to get your feedback on like the pitch itself. And then we just schedule a call and make it happen.
Do you find that's a bit different? Like there's pros and cons, right? Because when I'm looking at somebody and they're pitching me, I'm like straight up in, am I going to invest or not mode? When somebody's like, hey, I'd love your advice. Now I'm in like this help mode. And I don't know which one's actually better. I don't know where if my advice is good at all, but like it changes definitely the way I perceive it. I don't know how you played that.
I think that does really depend. It just really just depends on your relationship with the person and how much you've been engaging with them. Like most of the people we were going to for advice were people I talked to on a regular basis already. So it was already kind of like, we already kind of had that relationship. And so I don't think anybody who I didn't think was like a guarantee to invest, I probably wouldn't have I wouldn't have just straight up asked them to invest. I would have either like tried to pitch them on investing, or I would have like maybe talked to them and gotten advice first, depending. But I wouldn't have just like been, yo, do you want to invest or not? Like I think it is important to be thoughtful about that. I actually also think like there's two approaches to fundraising. There's the finesse approach where you try to almost get yourself preempted and kick off a process that way. And this is one of those things that I don't think people openly talk about a lot, but I think you can finesse the game a little bit. And some people do this really well. It's not what I did, but if like you got an offer to join Y Combinator tomorrow and you went out and shopped that, I guarantee you could probably get a fund to like throw down a term sheet and try to do your round. And like that stuff happens. Like people don't want to talk about it, don't want to act like it's real. And founders that pull it off, like often are not sharing this, but a bunch of people will like do things like that. It's the same reason why you get that first term sheet. Now, like the leverage is in your court and you can kind of go talk to multiple different investors. Like that's one approach. And the other approach is just like build your materials, you get your story, you build your list, and then you just start getting introduced to investors and like run a process until you have a term sheet. But both can work, but one is a little bit more, you're not raising, but you're like kind of like talking to people and having conversations and hoping to like that there's like some kind of trigger that then you can turn on a process. And I think usually when people talk about that happening, they act like it was truly just like
serendipity. It was actually.
And I know a ton of founders that do it like they very intentionally, like they know exactly what they're doing.
Well, it's a game, like anything else. And I think everybody that's party to it understands it. And so, but yeah, I think there's different approaches to it.
It was never my style, so that's why we didn't do it that way.
Let me ask you this, on the actual amount, you said you were raising 1.5. How did you get at that number? And you ended up raising like almost twice that. Was that planned out? Like you wanted to oversubscribe?
Yes and yes. So I think you've kind of, when you go raise, you have your good, like maybe like worst case, middle case, and like best case scenario for like what you can raise. And we had that planned out of like, hey, if we like don't succeed in this raise, like what does that look like? Or if we only get some of it, what does that like look like? Like we had a version of that planned out and like just a basic financial model for how much runway that could get us and who we could hire and like how we could basically go build product and go to market. And then we had like the middle case, which is the 1.5, what we were going to raise, we were hoping to raise. And then we had like a case for if we were able to raise more money, what could we do with that instead? Honestly, frankly, I think we did want to raise more. The reason we decided to raise more, the reason we didn't like go out for that number though, is it's like easier to oversubscribe than it is to like not get to the initial number you want. It's like, say you want to raise 2. It's like, it's easier to get to 1.5 and then go up to 2 than it is to say you're raising like 2. And then, because if you like try to get to 2, but then you're like stuck on like 1.4, it's psychology.
100%. It's a momentum game. I've shared this before. I'll share it with you, but we did this, like you did it strategically. When I started off and I was a first-time founder, I did this by complete accident where we literally were so like naive. We thought, and this is like a decade ago, there's less things or whatever, but my co-founder and I were like, dude, I think we just need like $250,000, right? So like we go out, we start raising $250,000. And then as we start moving, we're like, you know what, actually, I think we need like $500,000. So we move it up to $500,000 and then $1 million. And then we ended up getting, I think it was like 1.5 or 2 at the end of it. But it helped. It ended up helping because this momentum was like, we're always almost there. And so the next kind of investors, like, oh, especially in the angel side, right, is like, oh, okay, like you're 80% to your goal. Like, yeah, I probably need to make a decision. Like, when you need to raise 2 million and you're talking to somebody for $100K check, $50K check, I mean, a fund is different, but on the angel side, they're like, well, call me when you're almost there. You know what I mean? Like everybody wants to be the last money and not the first.
Yeah. And I'd say for most angels, it probably is just best to wait for them until, I think it depends on why you're talking to angels, but if you're looking for angels as like more for like, I think angels are some of the most helpful investors to have on your cap table, but a lot of times the best time to go after them is after you've got the momentum and are oversubscribed or whatever. But if you're talking, so I think even if you're talking to investors like that, like some fund that writes, I don't know, 150, 250K checks, they can't and won't lead you around. You'll get lots of these like, yeah, we're interested. And they'll just like sit there waiting to make a decision to see what's going to happen. Or they'll commit on like the condition that you get like some kind of lead, some kind of term sheet. So the whole thing is just a momentum.
Investors have perfected the art of like sitting on that fence. You know what I mean?
Yeah, sure. It's in there. And it's in their incentive. It's in their incentive.
That's
and
right.
that's fine. Right. It's part of the game. You've got to find the people that are going to like push you over. But everything to me is like getting to that point where you have the momentum and you have the leverage to then be able to, because it's also too like once you get to that point, it's also easier to choose, because if things go well, you want to choose like what investors do I actually want to work with, not just who will give me money. And the more people you talk to and the more momentum you get, the higher the likelihood is that you're going to get the round done that you want and get it done with people you really want to work with.
You've got this list, you've got people that are going to kind of make those intros. And let me ask about that. Like, what percent of your outreach was warm intros and what percent was cold?
Yeah, I'm actually so I got asked that a lot. I was almost exclusively, I don't think I sent I've sent a lot of cold emails in my time, but not for this fundraise. I think like almost everything was a warm intro or someone we already knew. And the reason for that is just like, I think it's just like hard mode. Like most investors don't want to it's just, they get so much inbound and it's very rare to get something that cuts through the noise that's cold outbound. And just like they trust it's always better for you to come in through a warm intro, all other things even being email, even if it was the world's best cold email. And so it's just a better strategy if you can pull it off. I have a separate thing I wrote on Twitter about just like how we got to the point where we could get introduced to so many different people. Cause that's the number one thing people asked about is like, how do you get like, it's actually not hard to get introduced to people if you have a way to get introed. But actually, the hard thing is not asking someone to introduce people to me. Like that's relatively mechanistic. It's like, hey, do you know this person? Will you put this blurb in front of them? And like, boom. The hard thing is being in a position where you know people that will like put that email in front of them and will say good things about you when they do. And that took years of just working really hard and building relationships for me to get to that point. I was not there like 5-6 years ago, or honestly, even like 4 years ago. But now my co-founder and I are there today. And so some of this stuff is just things, putting yourself in a position to eventually do this with your career. If you've not like worked in tech enough and like have some existing relationships, getting that many warm intros is probably harder. And so then I think your best option is to find a super connector, get them to believe in you, and then you kind of like back your way into getting introduced to people that way. But the core point is like, I think it's very hard to raise money and to get enough meetings, especially on like in a condensed timeline, if you don't have a way to get introduced to people.
So in most cases, like for you, not only was it warm intros, it was warm intros from people that you already knew. It's not like you had some kind of mechanism where you sought out a way to get intros as part of this process.
I did not. No, I wasn't an accelerator or anything like that. It was people I knew, and they were like pretty much always like people. There were like probably 20-30 people that introduced us to a bunch of different investors. So it's definitely spiky. Like there's people that offer and then don't follow up, and then like there'll be like one person that just introduces you to like 30 people.
Okay, and then so you're ready to press go. Like, how do you do it? Do you do all 200? Do you batch it? And then how do you schedule these so they're all like condensed? You know?
Yeah. So we did batch it. We started slowly. So we had the friendlies, then we did like maybe 10 to 15, probably not quite 15, but we did several conversations with investors that we like didn't care that much if they invest or not. Mostly just kind of like, it's a great, like in some cases we met some people that were like, oh wow, we actually did really like these people. We were mostly trying to figure out like what was wrong with the story. And then once we felt like this is...
Walk me through that. Like, how do you make sure you actually get feedback so that you can hone that pitch, so you can figure out, like, how do you do that? You're saying, you use those conversations to make sure you actually got the narrative right. What are you doing?
I think you're just looking at like what the questions are people are asking you. Like there's like usually like people are passing for a reason, assuming they're passing or just like ghosting you. And whatever questions they're asking you during the pitch is like probably the reason why they're passing. You can kind of like read into it, even if they don't tell you that's why they're passing. So if they're asking you about competition, if they're asking you about like, or if they're like, well, what's the why now? Like, why hasn't this existed before? Why wouldn't Stripe or Google or whoever do this? Like, you can probably back your way into like what it is that they're seeing. And then hopefully you can pair whatever you're hearing in your meetings with like other people you trust, like another founder that's raised before, for instance, and be like, I keep hearing this. And you can probably like extrapolate to exactly why like people are doubting what it is you're doing. And then you can figure out like, even if like you don't have a perfect answer, you can at least figure out like, well, what do I believe about this? And hopefully you address it earlier in your pitch. And then on the other things, it's even if it's something that like, I don't know, like you can't address everything. You at least have an answer that you have conviction in, because like sometimes you will just get asked about something and you're like, actually, I hadn't thought about that before. But and for the most part, or maybe you've thought about it, but you didn't have like a very like, high conviction, ready-made answer. And so after 10 to 15 meetings, though, you probably heard everything people are going to ask you.
Did you write this stuff down after each meeting, or you just kind of remember whatever stuff?
Record it. I had a thing that would like kind of transcribe notes, and then but for the most part, I just took notes like during the meeting, right after the meeting, and then you sit down at the end of the day and you just like, you kind of like think through and cycle through, okay, this, and I would also since writing's big for me, I would go into my memo, like basically anything I was getting asked about and struggling with, there was a section in my memo where I like wrote out exactly what I thought about it. And if you can like write about it, you can probably talk talk about it on a pitch meeting.
And then did you like go and add slides, like maybe to the appendix, so you can like flip to it when somebody asks a question? It's like ready.
This is another thing. I barely use my deck when pitching. And so I would send it to people as like an advance of like what they could read through, but I didn't have an appendix. Like most of the additional material stuff, I just pushed that to the memo. And so anything in the deck was mostly for them to read beforehand. Every once in a while, I would pull up a slide to emphasize a point I was making when we were talking, but I never wanted this to be like, here's slide one and here's like my problem.
So your conversations, solution. These are probably 30-minute meetings, probably on Zoom, and you're just kind of talking, no slides?
Yeah, talking, no slides. Like my process was I would usually start out, most investors are really, this is another thing that I think you have to work on tactically. I had to work on is that, so you're doing your meetings. Investors are really good at taking control of the meeting. Like they do this way more than you. And so I think it is in your interest to flip that paradigm and you're not trying to be an asshole, but you want to be in control of the meeting and like running with your own agenda. I think it's a lot of times people jump in and try to give their intro and then very quickly flip it to you so they can just grill you with questions. I'm even fine if they do that. Honestly, their intro will get out things that I was going to ask them about anyway. But as soon as they're like done introducing themselves, I'm trying to ask them questions about, okay, like, do you invest, like, say you're raising a pre-seed or you're like roughly at a pre-seed stage, like the labels get weird, but just try to like literally ask, like, do you invest in pre-seed seed? Like what's really your sweet spot? And then based on what someone tells you, you might literally hear, this person is like, they like to invest in things that has like 100K in ARR. We are not there yet. So it's like, we're automatically out. And so you can literally say, hey, actually, we can like kind of talk and like, get to know each other and stuff. But like, I don't think we're like going to be a fit for you guys right now because this is where we're at.
You're qualifying them. Like that's kind of.
Yeah. You want to qualify them and you also want to just get data out on like, what are they actually, because also too, you're going to hear something you can ask about like what kind of founders they like, what have they invested in recently. Like I usually had 2 to 3 that I cared about for each investor. And when you ask those questions, you can at the minimum figure out like, is this maybe a fit? And then 2, you can figure out what you should maybe double click on. Like if you heard them mention that they really, really, really care about like, I don't know, some technological shift in what's possible with technology and like what they're investing in, you can probably emphasize that in your pitch, if assuming it's true. Like there's different elements of the pitch that are going to resonate with different people. And if you ask these qualifying questions, you're kind of picking up on what someone cares about at least a little bit. And then that can direct what you talk about. And then the last thing actually on this point with qualifying questions, I forgot about this. I would usually ask them, my last question every time is, so we're building in like the tax compliance space. It's like very unsexy. And most people, you've either dealt with it and maybe know something about it, or you've like never even thought about it. And a lot of investors have never thought about it before. And so we would ask every single person, like, how much do you know about this on a scale of 1 to 10? And I would say something like 1 being, I've never thought about this before in my life. And 10 being like, I've dealt with this problem. I know it viscerally. And like, I know everything about all the products in the space. And usually people would qualify. And that was actually really good because that would tailor like how much time I need to spend explaining that to them, what this even is before I get into why it's a good product, business, whatever. So that like, just, it's really helpful information for you to make sure you're connecting with someone and having a good conversation. And then I would usually go into basically introducing what it was we were building. And like, I would kind of explain the market.
We'll go into the rest of it. I just want to say just one thing, because you're giving the founder side. I want to compliment it with the VC side. And I will tell you that what you're talking about doing all that pre-qualification happens maybe like 5% of the time, right? And I think what you're doing there is a few things. Number one is the reality is you're setting yourself apart, because if you're doing something that only happens 5% of the time, well, this is a bad thing, then right off, you're going to stand out. The number 2 thing is you talked about this is you're actually using that information live in that pitch. So your pitch just got better. The third thing though, and I see this and I notice it and I'm like almost looking for it, is by changing it up and qualifying them, you are putting them on their heels, and the dynamic changes right off the bat. And it's interesting when I'm put in this position, all of a sudden you kind of feel like shit. Because the reality is, like, in most cases, whoever has the money has the power. And this goes like for VCs to the LPs, and it goes from the VCs to the founders, and it just goes down that chain. That's just how it is, right? And so most of the time, like, we see a lot more founders than founders see VCs. When you flip that, and all of a sudden I feel like I don't really have the power anymore, it just puts me in a different mind frame. But also, I'm actually partially investing. Like, I know that a venture-backed company is going to have to raise and then raise and then raise. That's just the reality of it. So it's a legitimate skill. Like, it's not just the fact that the dynamic changes. It's that all of a sudden I notice, okay, this person's really good at fundraising. Like, that's a skill set. That's an important skill set for a CEO to have, because they're not going to be a profitable business soon, right? So anyways, that's just like everything that's happening in my head when someone does what you're saying you do?
Yeah, no, I actually think that's a great point because I think most founders don't really get to see into what an investor is like thinking. One of our angels, he's a serial founder. His name's Siki Chen. He's the founder of a company called Runway, and he has this thing he says of you have to get into the mindset when you're in fundraising that investors are trying to sell you. An investor because like they're selling the most commoditized product in the world, the US dollar. And that's like, now I think you can take that too far. He can do that because I think he still does this thoughtfully, but you do need to get into the mindset where like, especially like I come from dirt poor Ohio. Like I have like never, like I would never have dreamed 10, 12 years ago that I would be doing this with my life. And so it's like so when you come from a place like that, it is like a weird thing to go raise money. And I do think you should have respect for like people are investing real capital. Like you shouldn't treat it like a game. Like it is serious. But at the end of the day, like it is helpful to shift your mindset into realizing actually there's a lot of money out there, and that changes more into it's all a psychological game. But I do think if you flip that switch in your mind, it makes it easier for you to just like walk in and be confident and not be playing scared. Because an investor is going to feel that too, even if they're not going to say it. They're going to feel like, oh, this person, they don't feel like they deserve my money. And I don't think anybody wants to like invest behind someone who acts that way. Because to your point, like you're going to have to fundraise again, most likely. And if you don't think that person can raise money for the business, then it's hard to have conviction behind that investment.
Anyways, I interrupted you. You were going to go to the rest. So that's kind of how you started off. That's the first 5 minutes or so. And then the rest, you kind of tell the story and you hone it depending on what you heard.
Depending on the person, it's like could be as little as 3, as much as like maybe 7 minutes of like walking them through the business itself. And my goal there, I'm not really flipping through my slides. I might pull up a slide or two here if it's relevant to introduce a point. And mostly I'm just trying to like get them to the point where they understand. I think the basic structure was like understand like what this problem space even is, because it's not something most people have dealt with. And then you've kind of got them there, and then you bring them into like the history. Like I actually think there's like different types of stories you can tell. Like you can tell a story of your market, you can tell a story of technology and like a why now. You can tell your personal story. I would usually do a mix of telling my personal story, like explaining to them like this problem space, and then walking them through this like big moment in time in this market that we're in, and why this is a really like interesting moment in time. And then that would all kind of like dovetail into like where we're at today, and usually was and like including like talking about our fundraise, like how much we were raising, stuff like that. And then that just like led naturally into like, it was relatively short. You still usually had at least 10 to 15 minutes to talk, but you hopefully, if you didn't always go well, right, but most of the time people understood what you were doing, and then you can have a dialogue about the questions that they have. And hopefully just like a back and forth conversation about the business, about what you're trying to do. And then, hopefully you get to the end of the call and there's like either it's clearly that this person's into this, there's some kind of clear next step, and you move forward in the process.
Do you try to ask them like what their timeline is, what their process is, things like that?
I usually ask that at the beginning of the call. If I didn't though, I'll ask it at the end and be like, hey, so I know we're getting a time. What's your typical process from here? Like if I know it's a bigger fund, like do you have like how many different like maybe like one good thing at a bigger fund is to figure out how many different people have to be involved to make a decision. If you're talking to an associate, like it's probably obvious that they probably can't write the check. So it's like there's gonna be another piece of the process. So, but versus if you're talking to like a solo GP, it's like they're the decision maker, so they might be able to move quicker. So, but either way, like everyone's got their own style. So like fleshing that out is going to be good. And then ideally some kind of commitment on what next steps look like. That way you can action against that. If it ends very vaguely, it's hard to follow up on that. And also too, the investor's probably not interested, because when they're interested, there's usually next steps.
I got a few different questions. One is like you mentioned associates there. Did you specifically try and always like talk to a partner? Did you find there was a difference, better or worse, if you were talking to an associate versus a VP, principal, partner, whatever?
Yeah, I'm not hardcore on this. Like some people are like only ever talk to partners. And I think all other things being equal, it usually probably is better to only talk to partners. But I think there's a lot of associates and principals and whatever that either can do a deal or at least are like very influential and are part of getting somewhere. And like at the end of the day, if your only intro to a firm you're interested in is through an associate, then like you're going to take your way in the door. So I think if we had a way into a partner, we would do that. If our best way in was through like an associate or principal, or I just knew this person and I liked them really well. Like if I could have gotten introduced to a partner at a fund, but I knew one of the associates there really well, I'm actually going to talk to the associate first because we have an existing relationship. So I think it is a little bit case by case, but sure, if you can talk to a partner.
Did you have either a target like target dilution, target price, and also target close date? You use any of those things?
I didn't do an exact target close date. I had a ideal, like we ideally want to raise about this. And we want to not give up more of the company than this, but we can kind of like flex here. So I had a range. I didn't have like an exact number. I had an exact number for how much we wanted to raise. I did not have an exact number for like dilution. I had more like a range where we wanted to see, and I did not necessarily have an exact price. Although once we had a lead, then we had a price.
Sure, yeah, that's right.
And then
on the close date,
and then the close day, I generally would just tell people I'd be like, ideally like sooner than later, but like I would say I'd like to have this wrapped up by, I think we were raising going towards the holidays. So like ideally by Thanksgiving, we have this wrapped up, and that's what I would say. And so there's a little bit of risk in even like putting a specific date on it, but you need some kind of date or else you just look like it looks super open-ended. But what I tried to avoid is saying like November 18th, because if it doesn't close at November 18th, you lose credibility.
I've heard that advice given, like and I just don't get like who would ever do that. I think if you get back into a corner like you did, yeah, saying like, well, ideally is a key word, right? Like we hope to, ideally we close by this day. Okay, that's normal. Like obviously you probably have some ambition to close by some point sooner or later, things like that. But when people come in and they're like, yeah, so like our plan, like we're going to close 4 weeks from now. I'm like, dude, you have no idea when you're like, you can't know ahead of time unless you have a lead when you're going to close. So what's the point?
Yeah, to your point, most investors could tell, unless like you're truly in a spot where like that is true, and it's usually obvious when that is true. Like investors are going to know, and so and I think like trying to understand where investors are coming from and how they see you is important, because it's like I knew the investors were going to know that, and also it's just investors do this more than I do, so I'm just not good at playing the game and like bullshitting people. And so I actually do think like a lot of founders will try to finesse things a lot. And I have a couple friends who are really good at this. And so like more power to them. I am bad at it. It is not who I am as a person. So if you're just honest with people, like it was true. I wanted to wrap a roundup by around Thanksgiving. We're going to like that. We were running a process. We were talking to people. I was always honest with people about that. And the goal was to close it. And so even when we hit a point where we were actually oversubscribed and we were in the middle of like, we're like going to close this week, it was true.
That's different.
And I've been honest with people the whole time. No one ever questioned me. Like I was lying to them and like playing a game. It's just, I was honest. Like just be honestly, like if you're in doubt, don't try to game it. Just be honest. Cause I think there's a lot of advice on Twitter and stuff like that of like these more like finessing styles. And like, honestly, for most people, just like be honest, run a process, try to build a, like just do the basics really, really well. I think, sure, there are investors that like to be able to try to play the game, but I think the investors I want to work with at least appreciated that I was always dead honest with them, because that's also too how I want to work with them going forward. Like you're going to work with these people for a long time if things work out.
What about the amount though? You mentioned like you went out to raise 1.5. You knew in your case you had a worst, a middle, and like a best case. Did you share that with anybody before you got a lead?
That's a good question. I didn't share the ranges. I shared that we were trying to raise that middle case number. I did think it would be nice to raise more here. My thinking was literally like, okay, this market is tough. Raising the larger amount, I got some feedback on it. They're like, that's a big pre-seed. And I had a reason for why I wanted it. It's like, we're in a really complex market that like, I have no idea where the macro is going. I think there's good reasons to raise more now, but I was like, okay, well, I think I can at least have a shot at what we need to do with this much. It may not be my ideal case, but like we can do it. And so this is what I'm going to go out and try to raise. And this is like a palpable pre-seed, and then we'll just see what happens. And so it was kind of from that perspective. And then people would ask me though, like, well, especially as we started to have momentum and we were looking like we were going to get it done, people would ask like, well, would you raise more? And what I would always tell people is we would consider, if we oversubscribe, we would consider raising a little bit more, like somewhere in this range. But we'll like right now we're just focused on like getting this close, and we'll see what happens.
Because I've seen the other side, right? Where people come in, they're like, oh, I'm raising 1.5, but like if possible, like we could also raise 3, and you're like, well, which one is
you raising
like,
1.5?
Dilutes. It just dilutes and it goes back to everything we were talking about, like that confidence, like always with respect. But I think shifting the dynamics, putting them on your heels, like having that confidence. All that speaks to you saying, this is what I want to do, and this is like how I'm going to do it. And then, yeah, sure, things might change later, but like going in already with like 2 or 3 different plans is just soft.
Yeah, I couldn't agree more.
How long did the whole process take? Like you planned in September, you went out in October, and you closed by end of November. Is that about right?
I wouldn't even say we went out in September. I would say we started getting prepped in September. And so and that is real work. So I think we actually started raising for real and like probably like early to mid-October is when we like started this like practice run. And then we really like accelerated, like laid out like around October 20th, I think is when we like hit the gas and we're like, okay, we're going to go from maybe doing like 5 or 6 meetings a week to talking to as many people as possible. And so
how many were you doing? Like how in a day, how many?
I think it ramped. It started from like, I might do like 5 or 6 or 7 in a week, including friendlies, to by the middle, it was like maybe I would do 4 or 5 a day. And by the end, I was doing like 12. By the end, I was doing like a dozen plus a day.
How do you keep the energy up? Like on the one hand, you're perfecting it because you're just doing the same thing over and over. But like, how do you keep that energy up, on that 5th meeting on that day?
Yeah. It is hard. And like, you're definitely going to, you're going to have more energy for than not. I mean, the honest answer is try to get like, I just knew what I would cut on. I tried really hard to get enough sleep. Otherwise, just like know that it's for a time and just like you kind of do have to gut it out. A weird one is I didn't eat. Like I just didn't eat from like, I didn't eat breakfast. I didn't eat lunch. I would literally like basically not eat till like 9 o'clock at night until I was done with
that helped you?
Yeah, it did. It's weird. I drank a lot of coffee, but it's like, there's like something about like just not having food. You're just in like a pure adrenaline mode. And
it's so over 40. I suggest not doing that.
Maybe don't do that, but it worked for me. It worked for me.
That's good, man. And then how did you time it? Like the other thing that sometimes goes wrong is you get these intros and people are like, okay, cool. Yeah, let's talk in 2 weeks. Someone's like, let's talk tomorrow. Like, how did you did you do a lot of work to just like compress, especially those first meetings, or not really?
Once I was going, this practice run was almost kind of its own thing. I really wasn't trying to hit a ton of calendar density while I was getting it down. Once we were like, okay, we're just taking as many meetings as possible, I basically would just like, I would go to my CRM and figure out like, okay, I can get interest to these people. Okay, let's like go through, but I've kind of got like it tiered too by how much I wanted to talk to them. And I would just go through and try to get introductions. And then if my calendar looked pretty stacked and clear, I would like probably put less effort for a couple days into doing that and more effort in just doing meetings. And then I would kind of be like, okay, well, like next week, Monday is packed, but like Tuesday through Friday is like not that much. And I'm like a week and a half out from that. And so it's just as you go, you're continually like filling it up and keeping it full. And yeah, you've got like the people, if someone's like, I can't talk for 3 weeks, it's like, okay, you schedule it. And then you just like, it's almost like not even a factor. Like I had that happen. There were like people that didn't schedule us until like December. And then I just like emailed all of them. I'm like, yeah, the round's done. But yeah, it's like, fine, schedule it. But it just honestly, it was like, there was no like, I never like I didn't even use a calendar link. I literally just like meticulously tried to stack it as much as possible and just keep getting introductions. And then you can look at your calendar and know, and you're like, okay, this is pretty full. I'm gonna try to push through. I'm gonna try to hold. Because also you can kind of feel it too. Like most people are telling you roughly when they're available. So if most investors are like, if you get introduced to an investor on a Thursday, they're probably not going to be able to talk on Friday every once in a while, but most of them are like usually booked up. And so usually like you've kind of got like a week and a half lead time. And so as long as you're like a week to a week and a half, pretty stacked, you can kind of run it on that cadence.
And what did you find was the standard process for a pre-seed, like first call and then partner meeting, or like how many calls to a decision?
I think it's all over the place depending on the fund. Like a big fund, you could have a whole process, or a fund just has like a lot of partners, and also too, they might need to get to consensus, whereas some like it only takes one person to get it through. So it really does depend. Like some people we like had 5-6 meetings, like or it was just really structured. You'd have a meeting, you'd have a second meeting with like the same person, and then you'd go to them and another partner, and then you do like full partner meeting. And then other people, it was very like, they had a much less structured process, and they'd be like, okay, I want to dig into this. And so let's, like, I'll get back to you, or somebody might have wanted to talk to one of your design partners. So I found that most people's at that stage was relatively all over the place. Probably the main commonality is if there's more than one person involved, after the first call, they're going to want you to pretty quickly meet the rest of people. And then for me specifically, since it was me and my co-founder, I did all the first calls. So they had not met him yet. So normally after the second meeting, I would bring him in, and they would want to meet him and see that like obviously this other person was real, and that they like wanted to get to know like my co-founder, my CTO, and see him. But I tried to keep him out of the first couple meetings of the process, mostly just because it was more efficient for his time. And I think most investors too respect that, like, ideally not both founders are fundraising.
I think for the first call, yeah, that makes total sense. And were you ultimately able to get multiple term sheets, or how did that play out?
Pre-seed's weird too, where it's like term sheets are kind of this weird in between thing. Like we basically had an initial lead, and then we almost ended up like pulling in a different lead, because like we had somebody doing 600 that was like more or less leading a 1.5 round. And then we had somebody else come in and basically like want to do even more. And then they kind of like almost reset terms, but the existing investors were fine with that. And so it was like one of those things where it just kind of worked out that way. But we basically had a bunch of people that wanted to invest. And so I think ended up we had about 10 million in commits on about what was supposed to be 1.5 round. And then we chose, so basically going into Thanksgiving, we like really, really oversubscribed. And so we had the people, we did references on everyone we were considering taking money from. We negotiated a little bit on terms, but just got to a place where we felt.
Well, I was going to ask, especially on terms, like what were your big things? Like valuation, I assume, was the top thing you negotiated, or was there others?
I didn't negotiate it that hard. We did negotiate valuation. We ended up going up a little bit from where we were originally at. I actually had better offers for valuation though than what we went with. But I wanted to work with the people we picked.
What was that? Like what people say that sometimes, right? Like you don't need to go for the highest price. Like there's people, was that because of the vibe, or was that because of hard referrals from people who had worked with that person and you just knew they were going to be like value add? Like how did you think?
Yeah, it was a little bit of both. So there were two different scenarios I saw. One was just like, we didn't talk to a lot of multi-stage funds. But when we did, it was later in the process. And generally, I'm just really skeptical of like funds that are doing like pre-seed through Series E checks. Like nothing against them. And I hope we work with them eventually. But at that stage, $1 million check to a multi-billion-dollar fund is a call option. And so, and even if you really like the partner there, like it just creates all kinds of signaling risk for the future 100%. For you as a founder. And so I was really skeptical of those folks. And so some of those folks, that was why. It wasn't that I didn't like them. I didn't want to take money at that stage from a fund like that. And then others, it was because we hit this point where we did oversubscribe and we went from just being another company fundraising to being like a relatively hot round. I was really skeptical when someone who had just met me was trying to like offer me all of this money so fast with very little diligence. And it mostly felt like a lot of their interest was coming from the fact that like other people wanted to invest, so therefore they wanted to invest. And again, we're going to work with these people for a long time. And I want to trust, like, I want to understand how they think, like how they make decisions and like what they are to work with. And
so did you actually I just need to double that. Like, did you actually appreciate it? Because in many cases for founders, like they love a quick decision, like, but you're saying you actually appreciated the diligence and the work.
I love a quick decision, but I want to understand the conviction behind it. And so it's like, if someone would like, just like, I actually had an investor, one of our investors did make a really, really fast decision, but I understood their conviction. Like they're very people-driven investors, and they invested in a friend of mine's company as well. So I had some context from him, and he just made it really clear to me, like, hey, this is how we think. And like, we have so much conviction in like you and your co-founder. And like that, honestly, that's like our process. And so like, I understood it for them, whereas someone else, it was like, these guys just like crammed their way into meeting us because they heard about us, and then like I'm almost like found out we were oversubscribed, and then you could just feel the energy. Was they don't want to miss this deal. Yeah. Whereas others, like we had others that the firm that ended up coming in and led our round, they moved pretty quickly and saw that we were hitting urgency. But they did one interesting advantage we had is that going into Thanksgiving, like we basically went from, we had like 800 committed on 1.5, and then we were at 1.1 the Tuesday before Thanksgiving, and then Friday we were at, we hit like 1.8 or something like that. And then, so there's 3 days before Thanksgiving. And then by end of Wednesday, we were at 5 on what was supposed to be like 1.5 and trying to invest. And so it was like, because of that, everyone we were in diligence with though, they were doing the work, and they did the work to make a decision on whether they wanted to invest or not by Thanksgiving. And so when that spread and all these people were trying to claw in like the next week and a half before we closed, like it was very obvious, like all of these people, even if over the last 2 or 3 weeks they had moved fast, like it may have been 2 weeks to a decision, but they talked to they did like references, they talked to my co-founder, they met customers, like we spent a lot of time together, versus somebody else is coming in and they're like, they've met me once, they've talked to nobody else, they don't even know my market that well. Like it was clear from our conversation, yet they're trying to offer me $1 million. It's like, I personally just didn't trust that conviction, whereas I trusted like this person may have made a decision in 2 weeks, but I know they did the work and I know why they want to do this. And then of course, like on every investor, we did references. We talked to founders that they had worked with before and made sure that what we thought of them checked out.
And what was your max? Cause you had all this money you could have taken, like, you know, what was your max kind of like, was it dilution? Like you didn't want to dilute maybe more than 20% on a pre-seed? Like, was that part of the thinking?
Yeah, we definitely took on more dilution than a lot of companies at our stage would have taken. Like we basically raised something of like a seed sized pre-seed. And so like we could have taken a little bit less dilution, but I think it was mostly like we knew about how much money we wanted to have and what it would buy us. And so that there were reasons to do that. Mostly just around that we don't know where the macro is going. And then two, this was a really complicated space, and like having the flexibility to hire an extra engineer, have a few more months to get the traction we wanted was a positive to us. We could basically play even more to win versus like having to be really on a tightrope. And then the other thing was like, I think like we actually took on more money than we needed a little bit because we had a fund that we really liked that we really wanted to work with. And they had like a very like clear like ownership threshold they wanted to hit. And so we took on a little bit of extra dilution because we were excited about working with that fund. And so that was most of it. And then I think like with startups and dilution, like obviously you care about dilution as a founder, but one, I'm more or less a first-time founder. My co-founder is too. To some extent, like you're not going to get the terms that Parker Conrad's going to get if he goes and, like starts a new company. And then two, like even if and when you do get like pretty good terms, it's either going to work or it's not. And so I think like you're most optimizing for like, how do you get the best chances of a successful company, not like, like did I like 1 or 2 extra points of dilution pales in comparison to did this thing work or did it fail?
Awesome, man. Well, this was great. Tons of tactical details. Any like last words, any last pieces of advice, especially since, because you put this stuff out, I'm sure you've spoken to a lot of, you spoke to a lot of founders to get advice. You've had a lot of founders seek out to you, seek out advice from you. Like,
not much. I think just, I don't know. I just honestly like control what you can control, do the work. Like a lot of things just come down to like keeping it really, really simple. And then I do think anything we not talked about here is just, if you can get another founder that's done relatively recently the thing you're trying to do and just be at a texting basis with them, that's like the most helpful thing you probably could do to doing sales, recruiting, fundraising. I think that was really helpful to me. And if anybody is like has questions, I'm on LinkedIn, Twitter. You can shoot me a note there, and we'll do the best I can to help if I can. A lot of folks have done the same for me.
Andrew, thank you so much, man. It's been a great episode.
Cool, man. Thank you for having me.
If you listen to this episode and the show and you like it, I have a huge favor to ask for you. Well, it's actually a really small favor, but it has huge impact. But whichever app you're listening to this episode on, take it out, go to Product Market Fit Show, and leave a review. Please. It's going to help. It's not just going to help me, to be clear. It's going to help other founders discover this show because the algorithms, whether it's Spotify, whether it's Apple, whether it's any other podcast player, one of the big things they look at is frequency of reviews. It's quantity of reviews. And the reality is, if all of you listening right now left reviews, we would have thousands of reviews. So please take literally a minute, even if you're just writing like great podcast or I love this podcast, whatever it is, just write a few words. Obviously, the longer the better, the more detailed the better, but write anything, leave 5 stars, and you will be helping me, but most importantly, many other founders just like you discover the show. Thank you.